I talked to a guy years and years ago on the telephone. He had a little building down in South Orange Avenue, a little 3-story building, and he lived in New York. And I was looking for a building for a doctor friend of mine, and he wanted it to be near the university. And this little building abutted the, what was it then, Holiday Hospital. Wanted it to be right next to a hospital. So and this property abutted the hospital grounds, and it was on Orange Avenue. It was just an excellent situation, so I thought maybe I could buy that for him. I don't look for sale signs, by the way. But my prediction to you is that every time you find a property that has a for sale sign on it, or is listed by a broker, or it's for sale in some other way, that you will discover that the price is too high. Why do I know this?
You are a broker.
I used to be a broker. I used to be, for many, many years, I made my living as a broker. And of course, now, by the way, the price of the property ought to include the broker's commission, just like the price of any product includes the manufacturer's costs, right? And part of the costs of marketing this property is the broker's commission. I'm not talking about the broker added a lot of value to it. I'm saying by the time somebody decides they are going to sell their property, they've talked about it with other people, their wife, their husband, their in-laws, their neighbors, their other people who have sold, a broker perhaps, at a lawyer. And every time they've had that conversation, the price got a little higher. So by the time the thing comes to market, it's 10, 15, 20% higher than the intrinsic value of the property. In the case of residential housing, as you saw in the last business cycle, that got a little bit crazy. Now, and then I go to California and I go to Los Angeles quite a lot. And I go to Las Vegas quite a lot. And I teach a lot in Las Vegas. And we got to Las Vegas and we'd be having a class. This is about 2006 maybe, 2005, 2006. And Stu and I were out there doing a class in Tropicana or someplace. I don't know. And the residential market was going like house fire. And so we're teaching this concept that you ought to buy stuff that has cash flow so that if things go wrong, you don't have to give the thing back to the bank. You want to put enough equity in it that the bank doesn't control your life, and that you have a lot of big safety margin, blah, blah, blah. And some guy with gold chains said, I've been trying to take some notes here, and it looks like to me you're going to get like a 12, 15% return on this. Like that was a bad thing. And I said, well, yeah. You're in, you're out. He said, that's terrible. I said, well, what would be better? He says, 30%. I said, yeah, that would be better. But this deal doesn't make 30%, and all the deals I've looked at in this town don't make 30%. Well, he says, you can't look at the cash flow. He says, real estate in Vegas has been going up 30% a year for a long time. I said, well, I teach in Vegas 2 or 3 times a year, and I've been doing it for the last 12 years, and so I know that's not so. He said, it is, you can look it up. I said, what is it this year? He says, well, it's about that. I said, well, from last May until now, it was May, it's been 7%. I think it's going to go down to 0 pretty soon. It was 30% the year before that, and it was 24% the year before that, and it was 16% the year before that. He said, well, what do you see there? I says, yeah, but now, you can look on my website, someplace there's a white paper done by the Massachusetts Institute of Technology on the price appreciation of commercial buildings in Manhattan over a 100-year period. They found, 68 buildings that had been there for 100 years, including things like the Chrysler Tower and Empire State Building and so forth, and tracked their sales over the years. What do you suppose? Now, this is Manhattan, of course. But what do you suppose the average appreciation over a 100-year period is in Manhattan?
3%.
It's exactly 3%. Yeah. And over the last 100 years, what has the average inflation been?
3%.
About 3%. That's all. Manhattan is special, though, because 100 years ago, it was completely built out. Okay? In a place like this, or most places in the country where you've got plenty of land to build on, you have the scarcity principle. The more you build on it, the scarcer it gets, and so you got regular appreciation and scarcity appreciation. Manhattan, though, is a perfect example of what real appreciation is in real estate. It's a commodity, and so it should go up with commodities.